2016 has certainly been an interesting year for the markets, but it hasn't just been stocks that have seen a lot of activity. The bond market has had quite a run as well. In this morning's U.S. Bank Economic 360, U.S. Bank Vice President and Senior Portfolio Manager Mike Denneman joins us to discuss bond investments and what's behind these recent gains. He's with Business Courier publisher Jamie Smith in the studio. Gentlemen.
Thanks, Peg. Mike, thanks for being here today.
Good morning.
All right, bonds don't get as much attention as stocks do.
Right.
I guess they're just not as sexy. But this year, it sounds like we need to give them a little more time.
I wasn't going to go there, but you did. So you're right. You know, we talk a lot on the program about stocks in the stock market, but we don't ever really get around to bonds. And with what's going on this year, maybe a good time to revisit that. You know, you hear the phrase frequently, stocks and bonds, and you'd be forgiven if you thought because of that they were kind of the same thing. And that's hardly the case. You know, stocks, as we've talked in the past, represent an ownership interest. You buy a stock, you're buying an ownership interest in that corporation. Bonds, on the other hand, they don't represent ownership at all. In fact, if anything, it's more like a loan. If you buy a bond, you are lending money to that entity. So, like any loan, that borrower is going to A, pay you interest over time, and B, they're going to pay you back in full for that loan at some point in the future. So if we kind of extrapolate on that analogy, different types of bonds are, there's the corporate bonds where you're lending money to a corporation. There's treasury bonds, you're lending money to the U.S. government. There's municipal bonds, you're lending money to state and local governments, the city of Cincinnati, the state of Ohio. So, you know, again, the general perception is stocks risky, bonds safe. And there's a lot to that. But sometimes they can act pretty similar to each other.
And I guess we're talking about them today because they've had a good year in 2016?
They have. So far, so good. So again, maybe just to expand a moment on that last thought there, you know, if you want to grow your money, the idea is you buy stocks. If you want something safe and stable, you buy bonds. And so, by and large, that analysis is pretty accurate. Bonds don't fluctuate in price nearly as much as stocks do, but they do fluctuate. And some years, depending on what's happening in the economy, they can fluctuate more than average. And so this year, you know, we talked just a couple weeks ago that stocks finished the first half, despite all of the troubles, with a 4% gain, which puts them on track. Well, bonds, in many cases, matched that 4%. And in fact, in some cases, 5, 6, even 7%. So not only did they keep pace with stocks, in many cases, they outperformed.
Now, is there any correlation between that, or why did we see the gain in bonds?
Yeah, so there's a couple unique things happening this year that have really helped bonds. One is the Fed, of course. Anytime there's anything, you point to the Fed, right? But it was anticipated that there were going to be higher interest rates from the Fed this year. And the way the bond market works, higher rates mean lower prices. So it was anticipated that the Fed would be a headwind for bonds this year. But as we know now, midway through the year and then some, the Fed's been on the sidelines. So that headwind has not materialized, so that certainly helped. And then there's also what we refer to as a flight to quality. And that is what happens when, you know, there's turmoil around the globe. Investors are seeking safe and stable investments, and so they crowd into assets like bonds because they're looking for a safe place to put their money. So just like anything else, supply and demand, if people are buying and buying one type of asset, that's going to drive the price up, and that's what we've seen from bonds. So, you know, how does that play out for the rest of the year? Well, that's going to depend on the Fed. It's going to depend on whether or not things settle down with the global economy. Neither of those is a certainty, so it could be more of the same for the latter part of the year.
Okay, so we'll continue to talk about them.
We will.
And if nothing else, we've proven that bonds are sexy.
There you go.
All right, as always, thanks for being here and sharing your expertise.